The U.S. added only 22,000 jobs in August, a far cry from what was expected. John Stoltzfus joins us on this, Chief Investment Strategist, Managing Director at Oppenheimer Asset Management. John, thanks for joining us today.
Thanks for having me.
Why such a disconnect between what was expected and what actually happened?
Well, I think it's part of the nature of the non-farm payroll number. It can be remarkably exaggerated to the upside or the downside versus where the economists' expectations are coming in. For quite a while now, the economists have been pretty close to what was being expected, but I think in this particular case, and in the last, with all the great revisions that we had, very harsh revisions rather, that we saw, very simply the thing that they weren't factoring in some of the changes in the market that had actually occurred. What we mean by that is simply, we think employers are no longer warehousing employees. They are beginning to take into account changes that will occur as a result of AI, and likely they are making mistakes. They may let too many people go, or they may not hire enough people. Remember when they were warehousing people coming out of the COVID pandemic, they had a shortage of employees. Now it appears that there was an oversupply. So there's adjustments in that area. And then you have the fact that we have the tariff risks, how to judge tariffs. Companies became very cautious, and a lot of the guidance that we've seen from companies, even when they extraordinarily well beat expectations in earnings results and in revenue growth, the forward guidance is relatively conservative in many cases, disappoints traders, on a day-to-day basis at times. But what we must say is that it appears that it's more prudent than a lax behavior on their part, and likely this is a rite de passage that we're going through right now.
Okay, let me ask you about the decision by the appeals court there that is now questioning whether the president had the authority to introduce the tariffs in the first place, which is expected then to go to the Supreme Court. Is that adding a new layer, you think, of uncertainty for business owners?
I think most certainly it is, and even though we've seen, some of the analysis that has been done by Bloomberg itself, by BI, Bloomberg Intelligence, it would seem that there are other laws or codes of law that the president can utilize to bring about the similar tariffs should those that were initiated not be useful. But it certainly creates greater uncertainty. It causes the question becomes, are these tariffs actually going to happen, or are we going to be getting refunds of tariffs, whether it goes to the companies that are involved that export or the importers, or whether it's the consumers? My gosh, this becomes a rather tedious thing. The lucky thing is we have a lot of technology today. We're in an era of innovation, and probably somewhere between the algos and AI, we'll be able to get through it sooner, irregardless of which way things are determined.
That being said, is AI also affecting the jobs front in sort of fewer jobs out there, or people losing their jobs?
We would certainly have to say, particularly at the front end, as we've all heard that students graduating this year are finding a tougher time finding jobs. In the case of many interns who've had great summers with companies, are finding that offers are not forthcoming at this point. People are thinking it over. And this is not uncommon to these type of situations. I've been in this business for 42 years, so everybody always wants change. But when change arrives and when innovation disrupts, it naturally will cause some kind of pause and effect. The good news is the market seems remarkably, if we look at just the way the market has performed today, really this has not been a major pullback. If anything, it is a pause that could well refresh once the tendency to predict or project negatively on any piece of news that reflects uncertainty wanes somewhat. We begin to see where the workarounds and the carve-outs to all this stuff
all right,
are.
So with this in mind, what do you expect from the Federal Reserve?
from the Federal Reserve, we're looking for, and we were going into this, a cut in September, 25 basis points. We saw it very much as we saw last year's cuts, although last year's cuts was, 50 basis points in September. But we thought with stickiness and inflation still being reflected in a lot of economic data, the Fed's concerns would say probably a 25 basis points cut, and this is almost a free hall pass for the Fed to do it, and no one can say that it's it's they're being trying to fight the president or set something up or prove their independence. But a 25 bips makes sense to us, and we think very possibly in October and December we could see another pair of 25 bips cuts. The good thing is, remember, the Fed has brought its benchmark rate down from a peak of, what was it, 5.25 to 5.5 to 4.25 and 4.5. So it still has a lot of room to cut, so long as it can work within its dual mandate, which is to remain creating an interest rate regime that allows the economy to grow at a sustainable pace that does not cause untoward levels of inflation, while at the same time does not disrupt the job market. And with the unemployment rate ticking up to 4.3 from 4.2, the prior number, we'd have to say that the Fed has an amber light in the dashboard and is very much, we think, in a position now where it can more relaxedly do a cut. As we say, we think it's going to be 25. Maybe later on they could do a pair of 25s. They might even do a 50 later this year.
Got it. John, I've got to leave it there. John Stoltzfus, appreciate you joining us. He's Chief Investment Strategist, Managing Director, Oppenheimer Asset Management.